Hey everybody, it's Todd, the ETF professor. Today I want to put some pictures to words of a topic that I've been writing a lot about. I post the stories on benzinga.com and then I post them in our blog on the ETF Professor Premium Trading Service. And that is not being thrown off by an ETF's low average daily volume. A lot of experts say you should avoid an ETF that doesn't trade X amount of shares. Well, I am in the complete opposite camp. I have found, and this is through research I've done personally and through research other folks have sent me, lots of great ETFs that really their only flaw is they don't have what someone would say is great average daily trading volume. Right now we're looking at the top holdings in an ETF called the PowerShares Internet Portfolio. Sorry, the PowerShares NASDAQ Internet Portfolio, and this ETF does trade on the NASDAQ under the ticker PNQI. Let's look at some of the top holdings. Looking at the top 10 holdings right now. Over here, the top 5, eBay, Google, Amazon, Baidu, Priceline, throw in Yahoo and Akamai. Those are all stocks that trade well over 1 million shares a day. And the point of me showing you this ETF is it trades less than 9,400 shares a day. That's right, PNQI trades less than 9,400 shares a day. But I can guarantee you this much. If you want to be involved with this ETF, you want to buy it. You will see that you will not be subject to a wide bid-ask spread, and that is because the underlying components are all heavily traded names. If you want to establish a position in PNQI, I would be stunned if you told me you saw a 15 or 13 or even 12-cent bid-ask spread simply because the underlying components are heavily traded and liquid themselves. I'm going to give you another example of why you don't want to avoid all thinly traded ETFs. And this one takes a little bit of me swallowing my pride because this is an ETF I have actually been bearish on, and that is the Market Vectors Egypt ETF. I've been bearish on it for fundamental reasons, and that is just geopolitical issues in this part of the world make it very, very hard to be bullish on Egypt, North Africa, the Middle East for extended time frames. We're looking at the chart from August 22nd. This is actually a pretty good volume day for EGPT, excuse me. Normally the volume is below 105,000 shares on the day, but look at what we would have missed if we just focused on an ETF's volume. We would have missed this great run higher in the early part of this year, and there were 1, 2 great shorting opportunities there. And then a great bounce, and then another run higher. I'm not saying anyone would have caught all those moves. Probably not. Only a perfect trader or a computer would have caught all those moves. But the point is, we don't want to avoid ETFs just because they have low average daily volume. Now I'm going to show you another example. I'm doing this through myriad asset classes. EGPT is obviously an emerging markets ETF. Now we're looking at ticker ROOF, ROOF. This ETF tracks REITs. Look at its average daily volume. Sorry, its volume for August 22nd. Barely over 2,500 shares. Now, that's a pretty typical day. You'll see 2,000, 3,000 shares change hands in this ETF. But look at this great move. So we'll go to January. It was around 17. Now it's trying to make a run towards 22 if it breaks this double top here. And I'm going to give you another great example because I want to show you that this pertains to all asset classes that ETFs represent. Looking at the soybean ETF, I'm sure you've probably heard about the corn ETF and maybe the wheat ETF. They've just been on fire this summer because of the droughts. Soybean, SOYB, this is actually a pretty decent volume day, August 22nd, at over 69,000 shares. You see the volumes really started to pick up lately, but this would still qualify as a quote-unquote thinly traded ETF. And for those folks out there that say, oh, I can't trade an ETF or can't invest in an ETF because it has low volume, you would never have looked at this and you would have missed this great run. This is over 20%, 23 to 28. I'm not saying you would have caught all of that. I may not have caught all of that. But the point is, we cannot avoid ETFs. We can't discriminate against them solely based on volume.